Hello and welcome. You're with us here on Markets Next Week, your stop for a complete picture of the trading week as well as important cues for the coming one. I'm Abha Bakaya. A rather subdued week this time, albeit with a positive bias. Benchmarks saw a gain of about 1% each. Let's first go across to Share as he walks us through all the market action for the week and also some of what we're watching out for in the week to come.
All right, before going on to next week, let's start off by taking a look at what really happened last week. When you're looking at the Nifty, it went in and saw gains of almost 100 points, and this converts roughly into slightly over 1%. So it's been a reasonably strong week. When you're looking at the mid-cap index and the small-cap index, they went in and saw a slight bit of an outperformance as well to the Nifty itself. As far as the larger stocks are concerned, you'll see that stocks such as Eicher Motors, Bharti Infratel, Maruti, Z Entertainment, all these had reasonably strong gains. Eicher deserves a separate mention. Very strong results coming in this quarter, and also the stock is going to see gains of around 17.5% over the last 5 days. On the losing end, again, Dr. Reddy's is one of those stocks which deserves a mention. Company went and announced its earnings, and after the earnings, the stock has been on a downward move. Besides Dr. Reddy's, is also Tech Mahindra, GAIL, and Tata Steel, which on a weekly basis saw downward moves. Going on to the events next week, the first major event, which will be most important, is the GST. The government will be holding meetings with the Congress to discuss more on the GST. Also, the next week, the government will introduce the GST bill in Rajya Sabha. So that's also what we are understanding. A couple of more other data points are that the Japanese cabinet will be meeting to approve a stimulus package on the 2nd of August. As far as economic data in India is concerned, Nikkei India Services PMI for the month of July will be also announced in the forthcoming week. Besides that, there are a whole host of earnings. A few important earnings will be Tech Mahindra, HCL Tech, and Tata Power. And there are also a couple of IPOs which will be starting off next week, SP Apparels and Dilip Buildcon. So there are quite a few things the markets have to contend with, and it'll be interesting to see that the upward move that we are seeing over the last week, does it really continue to the next week or not?
Also a stellar show on the derivative front. With expiry this week, the Bank Nifty saw gains of over 6% and the Nifty gained over 4% in the July series. Piyush has more of all of that F&O action.
So after seeing consolidation in the last week, Nifty gained 1% this week. For the last many weeks, we have been talking about 7700 to 8620 as the range. But this week, we have managed to close above it. Now, till the time we are going to hold it, we are now looking towards 8900 to 9000 levels. Now, why are we saying that? Because after the July expiry on Thursday, now the August option spread, it indicates 8500 to 9000 range, which means the maximum put open interest is around 8500 and the maximum call open interest is around 9000. Typically, the open interest actually tells you where the traders are actually now putting on their expectations about the Nifty levels. Now, the interest spread is going to build up more the next week, as at present it is on the lighter side. Overall, if you look at the VIX index or the volatility, it remains stable. The Nifty future open interest is now starting with about 20% higher open interest than July series start. Premium is around 40-point range, but slightly lower, but you can say it's similar to the last series. Now, the good part is that we have seen about 10,000 crores of net buy from the foreign institutional investors in July series, and trend does not seem to be changing at present. We have been moving higher with good buying in cash and derivatives both. On the FI side, they continue to hold long index future contracts around 5 times higher than the short index contracts. So on the index, the bias remains bullish. If you look at put to call ratio or the PCR ratio, it remains around 1 times. For the last many weeks, it has remained there, and still there is no heavy bias towards call writing, which is generally a good sign that less resistance is going to be offered on the upside. IVs, which is the implied volatility, they have not been supportive of the writing either. Now, if you look at the call writing, only 2 calls are short for every 1 put short, and only about 45% of calls are written for the total calls. And if you remember, for the last 2 weeks, this has remained the same. On the Bank Nifty, we are seeing higher range of 18,800 to 19,500 as the option spread versus the last week range of 18,000 to 19,000 range. This means we saw the Bank Nifty actually gain 5% open interest on the Friday. Now, along with the broader market trend, earnings will continue to drive Bank Nifty next week. Also, progress on GST also is going to be one of the factors which the traders are going to watch out for.
Let's welcome in our guest on the show, Mayuresh Joshi, fund manager at Angel Broking. Mayuresh, good to have you with us. As we were just talking about, a fairly subdued week, a lot of earnings, of course, but otherwise quiet-ish on the index. Big news of stimulus in Japan, also not really doing anything to move markets. The Fed was quiet. What, according to you, should we look forward to next?
Hi, Abha. I think the markets are going to react clearly to how the earnings season is going to pan out. You've seen a mixed set of numbers come through so far. That is the biggies that are probably going to drive the result season going ahead. So capital goods, the rest of the PSU banks will determine the trend going forward. And there's no doubt, I think, the kind of liquidity glut that we are witnessing in the markets is expected to continue. With the kind of denomination that we've got in negative yield terrain, even worldwide, there is ample scope for funds to keep on coming into an economy like India, which is far the best economy probably in the emerging pack. So yes, I think the liquidity might have the surge in the markets to continue probably in the next few weeks from a short-term perspective. But earnings probably will have only the effect in terms of re-rating, and that will only come in the second half. So largely I think how the capital goods and PSU banks are going to perform will decide the trend for the rest of the earnings season.
So we're still watching out for some of those big numbers, Mayuresh. But in terms of where or how we are looking compared to some of the other equity markets globally, a lot of the good news or even the bad news seems to be priced in at this point of time. Is there any risk to a downside, or what do you feel is required to really push us now to higher levels?
As I mentioned, I think liquidity is probably taking the markets higher, not just in India, but I think worldwide. But largely, I think in terms of trigger points, the markets are expecting the GST to probably get cleared, and that's going to be one big reform that India Inc. has been waiting for. Secondly, I think on the global scale, what kind of move the Fed does over the next few months should be keenly watched out for. And what really happens with the Brexit is largely an unknown that we're probably staring at this point of time. So largely on the domestic factors, a huge amount of gestation has taken place in terms of monsoons coming through, the GST expected to come through. But largely, as I mentioned earlier, I think it's the earnings which is going to create a re-rating for the Indian markets. We are nowhere cheap at this point of time. So even on a 5-year, 10-year average, I think we're trading at fair valuations, 17.5, 18 times forward earnings. And that probably will determine the course going forward. So unless the earnings improve, you will not see a significant re-rating into the market. If the GST gets cleared, it's a sentiment positive, the liquidity might continue as I mentioned earlier, and that might push the markets higher. But for the genuine re-rating in terms of multiples, the markets will have to wait at least for a quarter or two before we see some respite and a gradual consistent trend coming through.
Do you feel that some pockets of the market, Mayuresh, for instance, NBFCs have run their course, or is there more demand still for some of those themes? We've seen them consistently run up, and there really seems to be no stopping them.
Oh, absolutely. And again, I think one really needs to differentiate between all the NBFCs. Between the NBFCs, the housing finance companies have done really well. The cost of funds have come down. The kind of advance growth that we've witnessed and are expected to witness going forward, specifically on the retail side, should hold up their return ratios. And again, asset quality has held up pretty well. If you look at the other spectrum of the NBFC part, which is microfinance, MSME financing, and then the numbers have been encouraging as well. So if you look at Bharat Financial's numbers, I think numbers were extremely encouraging, whether they'll be able to hold on to the trend, both in terms of securitization going forward, maintenance of their capital adequacy, and probably maintaining NIMs and spreads is something to be watched out for. So stocks like Bharat Inclusion, you're probably looking at Ujjivan, Equitas are doing well. But again, I think the conversion to a small payments bank is going to pull down their ROAs and ROEs to a certain extent over the next few months. So that can't get offsetted by the kind of AUM and credit growth that you might witness. The third part of the NBFC packet would probably be the rural financing companies. And there again, I think you've seen mixed set of results come through. Asset quality deteriorated for a few players. But largely, I think the underlying is that if monsoons are good, if the state commission recommendations do come through, you will witness growth there. But again, I think valuations is something to be looked out very, very keenly. So I'll be extremely selective when I look at the NBFC pack from this point onward, where valuations probably are looking far more reasonable. And one really needs to pick and choose within the subsets that I just mentioned.
We take a very quick break on the show. Listen in to some of the market commentary that we've been getting for you through the week. We'll be back in just a moment.
Markets are being driven higher by the liquidity that's been pumped into the system. So we're all kind of being blinded by that, and obviously at the moment there's no immediate kind of downside to this. Liquidity-driven markets always take us a little bit higher than we should, and more stretched in terms of valuations. I think because Brexit kind of got put back to maybe the end of the year in terms of negotiations, that this is really kind of more status quo from that aspect.
The thought that if we don't see the policy stance change, then we are back to where we have been for the last couple of years, where beginning of the fiscal year, hopes around a second half recovery become strong, earnings growth expectations are high, markets rally based on that, and then that fizzles out as reality sinks in. So in our base case view, we're not assuming any change in policy stance towards any reflationary stance anytime soon. In that case, the current earnings estimates are definitely very, very optimistic, and that could be a drag as we go into the year. The risk reward at these levels for India in absolute context is definitely unattractive in our view, given that India is trading at peak valuation multiples versus history, and earnings growth expectations are building in a reasonably sharp uptick in earnings growth and growth recovery into the second half. And talking to investors, a lot of these hopes are premised on monsoons, on pay commission boost, and government spending, which in our view, at least in the base case, is going to have marginal impact. So we'll see continued muted growth recovery, not a sharp uptick. A sharper sustainable growth recovery needs either the private capex cycle to pick up, or we need the negative impulses from fiscal consolidation and monetary policy being behind us. And lastly, obviously the biggest thing in the pack also is the banking system. So we need to see the NPLs getting resolved, and not only getting resolved, but also growth capital being available to the broader banking system to start supporting growth rates. We still don't see any of these happening in a meaningful way anytime soon. And that's the reason why we think the estimates are definitely ahead of reality. So at current market levels, 8,500 levels Nifty, the risk reward is unattractive. We did say early in the year that when markets had touched 7,000, the risk reward was attractive. Not at these levels, surely.
Well, speaking of earnings as well, L&T reported numbers. Let's go across to Piyush for more on that fine print.
And let me start with saying that this time the results are going to be slightly hard to understand because there is a revision of accounting norms. So first quarter we have again seen, because of Indian accounting standard revisions, it means the numbers actually were not comparable when the analysts actually were looking at the preview. Now the net profit has come around 46% at around 610 crores. The EBITDA margins, they have expanded by 50 basis points. And if you look at the order inflow, which is the most tracked number for L&T, the order inflow is up 14% at 29,702 crores. Now let's remember, because of the 15% order inflow guidance, now it was expected that if L&T is able to score around 28 to 30,000 order inflow in this quarter, it would be on track. So the order inflow should not disappoint the analyst. Now also the international orders, they actually formed around 44% of the total order inflow. The order book is up 8%, so it's again higher, which is good for the company. International order book formed around 27% and expect it to go slightly down because the domestic orders are going to pick up. Now what has improved and what is working this quarter is power, infra, heavy engineering, IT, financial. Most important, hydrocarbon has returned back to profitability, which means the loss-making orders are almost towards the fag end now. Let's look at the margin performance, and if I look at the margins, what's telling me infra margins have improved, power has significantly improved to 5%, primarily due to higher execution of the orders which they won. Then again, heavy engineering, sharp improvement, 9%, loss-making orders going out of the order book. You look at electrical, hydrocarbon 0.4%, slightly worrying, but still it's better than the last time. IT financial margin almost has improved across the segments, which is a good sign. Only other segment, which includes shipbuilding, where they are making losses, that remains a concern. So overall, if actually you're going to summarize, you will say that in terms of orders, the trend is good. In terms of margins, the trend you can say stable or slightly improving. The 2 points are very important. Hydrocarbons, we are now seeing finally light at the end of the tunnel, and also heavy engineering, it seems the worries actually are now going down. Infrastructure remains the same, but overall, let's say L&T results are largely stable. The analysts actually would have asked for more, but still, it's not that worrying.
Mayuresh, capital goods is one of the pockets that you also touched upon, where earnings were keenly eyed. What do you feel is going to be the tone with regards to that pocket of the market going forward? We're still awaiting other numbers in that space as well. Do you feel momentum has picked up enough? Are the markets still waiting for more?
No, again, I think if you look at the ground realities and the kind of order flows that has come generally for the sector, the order flows are still looking a little bit sluggish. So if one really assumes that the private capex should follow the government capex and the front loading that the government is doing for this fiscal, the large expectations are that the second half should look much better for the capex oriented companies. Having said that, probably one also needs to understand that what kind of margins these orders are coming at and what kind of execution probably happens. So the net working capital requirement for a whole host of capital goods companies still remain extremely high, which pulls down their EBITDA performance as well as their cash flows that they generate from their core operations. So largely, I think I'm still expecting subdued set of numbers for the whole universe, though some pockets are expected to do well. But largely, I think capital goods will show signs of revival once the capex signs are seen evidently in the economy. And if that probably happens, you might see some uptick happening in numbers from Q3. But largely, I think for Q1, Q2, I'm still believing that the numbers will be sluggish, the margins probably a little bit subdued, and that will have a performance, and that might have a muted performance on their operational performance.
What about financials as well, Mayuresh? Again, PSU Bank's a pocket you're looking at. We did have PNB come out with earnings. Again, we're still watching out for some of the bigger ones within the banking space as well. What's your takeaway there so far? What are you watching out for in terms of commentary?
Again, I think largely it's again a well-known fact that the corporate exposure of banks, whether they be the larger private sector ones or the public sector counterparts, they're still struggling in terms of the end user industry, still not able to cope up. So you're still seeing the stress come through in terms of the GNPAs and the net and NPAs. But largely, I think one might witness with credit growth expected to pick up in the second half and credit costs expected to wind down again in that same time period. So the kind of provisioning and the kind of proactiveness that the banks are showing probably in this quarter and are expected to show in the coming quarter as well, Q3, Q4 numbers should start appearing a little bit better. So one really expects stability to come through in terms of asset quality Q3 onwards. And there onwards, I think it's going to be a story of how credit growth takes place. And largely, again, in terms of the return ratios, I think the private sector banks have held up pretty well. Though the valuations of public sector banks are extremely appealing at this point of time, my own sense is that the sluggishness in terms of slower advances, along with the kind of higher credit costs that we're witnessing in the economy right now, that might have a telling effect in terms of slippages still remaining high, provisioning remaining high, and that might drag down their return ratios, specifically the capital return ratios.
All right, let's take a very quick break. We'll continue this conversation on the other side. Do stay tuned. Yeah, with us here on Markets Next Week, we're in conversation with Mayuresh Joshi, and we're discussing some of the themes to watch out for next week as well. Mayuresh, we're counting down to policy once again, and by all indicators, it doesn't look like much should be expected from the central bank this time, but do want to get your thoughts on it.
No, again, I think I believe it's going to be a status quo this time around, because I think the RBI will wait for data points to come through. And the kind of data that we've seen, both on the IIP as well as inflation inching up, I think that is going to have some amount of headwinds when RBI takes its call. But again, largely it's going to be a status quo this time around. And again, I think what the Fed does is going to also decide the future course of action for a whole host of monetary policies around the world. But again, largely I think expecting a status quo from RBI this time around.
Okay, OMC, that's another theme that's looking attractive to you. So talk to us about, what the kind of potential upside you're watching out for there, the kind of factors at play as well that you're keeping in mind.
I like this theme for a length of time. And again, I think the key attributes over the past few quarters have been lesser working capital coming through, with under recoveries going down, specifically on auto fuels. The OMCs did expand their balance sheet growth, the net debt levels did come down. Again, I think with crude expected to stay in a very tight range over the next few quarters, to say the least, this does have a telling effect in terms of how the margins will play out. With the kind of capacity expansion that they've done, with the kind of plants that are coming up, the GRMs are expected to remain very steady over the next few quarters and improve thereafter as new capacity start getting commissioned. Having said that, probably I think the next kicker for them will be the marketing margins, and any increase from what we've probably witnessed over the past few quarters, both in terms of petrol and diesel going up. I think that does have a huge implication in terms of the EPS. So my own sense is that the marketing margins will steadily inch up, which will have a positive effect on the EPS and earnings going forward. And again, I think the kind of plants that are coming up, I think the GRM should hold up. So yes, again, as a space, I remain extremely optimistic, at least for the next 12 months.
Okay, well, most of the auto numbers have not been inspiring as such, fairly flat, but select stocks have actually seen quite a bit of traction, and certain numbers have been okay. So, for instance, an Eicher, of course, has been very positive. We've seen Maruti in terms of stock price action looking very good. New highs this week, for instance. Bosch has been very strong. What are the trends that you're tracking within the auto pack, Mayuresh?
Now again, largely if I divide the auto pack again into three components of two-wheelers, four-wheelers and the MHCV segment, the two-wheelers are expected to deliver greater volume growth in the second half. Once the monsoons are better, once you've got your pay commission recommendations coming through, I think the second half will be much better in terms of volume growth. When it comes to the PV side of the business, the four-wheeler segment, the competition has increased, but again I think with the kind of product mixes that we've seen across segments, my own take is that the volume growth should be quite reasonable, even for the four-wheelers. For the MHCV, I think you're already working on a very high pace. There might be some sluggishness come through over the next few months, but largely, again, I think FY18 should be a comeback year for the MHCV segment. My own sense is that the kind of discounting levels that we're witnessing right now, once the credit activity picks up in the system, once you've seen some signs of capex picking up, and again, I think some inherent signs of corporate earnings picking up, you will inherently see, I think, the discounting levels go down, and with volumes going up, the operating leverage should start kicking in. So I'll be selectively looking at each of these spaces. Within two-wheelers, I think two-wheelers is something as a pack that I like over the next 12 to 24 months. For the CV side or the PV side of the business, I think we need to be extremely selective, because valuations, in my opinion, are a little bit on the fairer side at this point of time.
Any select mid-cap names that have been on your radar, Mayuresh? A lot of earnings that have come in as well, and specific stocks that have also, of course, otherwise been active. In terms of earnings, by the end of the week, we had, divergent trends on those mid-cap IT names, Hexaware, Persistent. What really caught your eye?
I think IT might still continue to remain sluggish because I think Q3, Q4 is expected to be seasonally weak for IT companies. Q1 probably plagued by wage hikes and the visa cost impact that we've seen on the EBIT and the EBITDA margins. So I think the outperformance might have to come from Q2 itself, which is a very difficult task to probably come in one quarter itself. So I think IT companies might underperform with its large cap or mid cap for the better part of FY17. But yes, I think it's no specific buy or sell recommendation, but I think a whole host of companies did present good set of numbers. SKS Micro, which is Bharat Inclusion, gave good set of numbers. Biocon had a good quarter as well. Navin Fluorine had a good quarter. Transformers and Rectifiers gave a good operational performance. Visakha Industries gave a good operational performance. But I think whether they'll be able to replicate this over the next few quarters consistently is a trend that we need to see. And again, my whole purpose and the whole point is whether valuations are attractive for all these companies going ahead. So one really needs to be selective, but these companies did give a good operational performance.
All right, Mayuresh, thanks so much for joining us on the show today and running us through some of the trends this week. That's where we leave it. Thanks so much for watching.